And welcome back, everyone, to another RLT Pivot podcast. My name is Tracy, and once again, I am joined with my amazing co-host, Mr. Dan Jansen. How are you, sir?
Doing fantastic. So good to be back, as usual, for another episode of the Pivot podcast. With the service you provide, because, again, if you're a technical trader, a lot of times, I think a lot of times people get blindsided, right? So they see a certain gap up and they're a gap trader. They're trading on specifically just volume or just a certain candle pattern or something like that. I think it is important to understand the full picture, because I think by having and following the money, kind of the reports that you're providing, having that information will give you an inherent, whether you're using it to swing trade or day trade or just do a position build or something like that. I think all of that information could be extremely valuable going into a trade. We were just talking about confidence. Having that ability to know, okay, at least I know I'm not the only one thinking that this stock is going long, and knowing that there's a big hedge fund that is also placing trades. I think that would help give some of that confidence, no matter what technicals that you use. But I also see that information. You could have the most bullish hedge fund out there in the world, and that day that you want to trade, it's a bearish day and the market goes down. So I do think that information could be more valuable for a longer term move or swing. The question I think that the traders will have is really what's the best way to interpret that information for them?
Yeah, so a really great example is I had a really quick introductory call with Jeremy of Real Life Trading. And we were just kind of having just a general conversation about I was learning a lot, asking lots of questions about real life trading so I could learn more about both of you and your service you provide, so I could just learn more about it. And we talked a little bit about investing and trading really quickly. And one example he gave me, he said, he gave me a screenshot of a Slack channel. And he said, here's today's trade. And it was back in June, it was shorting AMD, Advanced Micro Devices, and I think it was made 1.4% on a day trade, risk 1%. That's my kind of trade. It was something to that effect. And I was like, that's awesome. And my response back to him was, when I went back a month, so I was looking at Advanced Micro Devices, when I was looking at my research and analyzing it in the month of June, billion-dollar fund managers were selling Advanced Micro Devices. So I was looking at this data and, okay, well, will this work every single time? Definitely not. But there's another level of confidence knowing that, okay, well, AMD was a short in your community. AMD was a billion-dollar fund manager, kind of a dump. They sold pretty hard on that report that I was looking at from a month prior. And then from my trend roadmap, the short-term trend and the long-term trend were both down. So it was almost like any sort of bounce, it's being sold into. So now you have this other level of confidence to say, okay, well, I'm following my risk. I'm following the setups that I'm comfortable with from real life trading. But then also, okay, well, I know billion-dollar fund managers are also selling AMD this month. And let's say hypothetically, this is the second month in a row they've been collectively selling AMD. Then to me, that would be something where I could have a slight edge that would give me the confidence to click the button.
Now, how do you know if they're buying to close or buying to enter or selling to enter or selling to close a position?
Well, I do have a slight social life. It's very small, but I do track an awful lot of the month-to-month accumulation and the selling and the buying. So I watch exactly what's going on. So I won't usually report on it unless it's enormous, but I want to see the consistency. So I think it's the consistency that's really important. So as an example, we've all come so accustomed to these behemoths of large cap tech, but it's hard because you listen to the news, and in one instance, it's so easy to sell because they're so liquid. And then the other instance is maybe this is where people go to hide because, I mean, how many Apple products can they sell us and keep selling us the exact same phone over and over again? So you start to question, okay, well, you have this story in your head, you have this story on the news, but then for me, the other level of the differentiation is, okay, well, what are the $1 billion fund managers doing collectively? Because they know valuations way better than I will. They'll have modeling way better than I will. And then secondly, what does the chart say? Because that's just kind of the pulse of everybody. So the short answer is I think it's always going to be hard. But I think managing your risk and just trying to find that consistency is really important.
Right. Right. No, I love it. I think it's really cool. Now, what are some of the most common investing mistakes that people might make?
Common mistakes, I would just simply say, are kind of winging it. A lot of the time when I was working with a lot of high net worth investors, their portfolios became just like a collection. They were investors. A lot of them, some of them weren't traders. So they had these positions for forever and they're never going to unload. So when it is time to risk manage, so it's like they would always wait for the market to be down 20%, no different than right now, and then say, what do I do?
Mm.
And then you're like, oh boy. And you're like, and well, tell me a little bit about your strategy. And I would say they were kind of winging it. When I worked in Massachusetts, I had some of the legacy clients that have been with the company for 30, 40 years. And they were just like so nice, but they're not budging. Some of them were in the Fidelity funds for 20, 30 years. So it's like, what should I do? Probably stay the course. And for a lot of the long-term investors, but for some of the traders, some of their processes were more around like, well, how did you get to this idea? And then with a fun Boston accent, I can make fun of it because I'm from there. They would say, well, Crema likes it. It's like, well, is that really your whole thesis? When's Jim going to call you and tell you to get out? And the answer is, I guess you have to watch Mad Money to figure it out, and you might not ever figure it out. So I'd say winging it was a huge one. I would say that most people don't really have a buttoned up financial plan. And I think that's really hard. So it could be just as simple as having beneficiaries on your accounts to as more complex to having an estate plan. So these were some of the kind of the pitfalls I saw. No plan, no financial plan, very lack of risk management plan.
Fair enough. That winging it, it's you're amazed at how many times somebody can look at a market, or they're looking at their investment going, no worries, I can hold, I can hold, I can hold. It's long term. I need this in 20 years. Everything goes up, et cetera, until you actually experience that. And it does go down that 20, 30, 40, 50% pullback. And all of a sudden that emotion kicks in, takes over, and that's when you start to forget all of the things that you had before. And that's why we teach it's so important to have a plan in place no matter what, and that includes the risk management. You know what your risk is at all times, and going forward with that, because when you're faced with that emotion of that pullback, that great big pullback that was so easy for you to analyze when you were in a positive trade, but now that you have it there, it's so much more difficult. So having that plan keeps you from becoming that deer in a headlight. And it's incredible. And it's no different than having people say, well, I'm going to wait till it drops 50% before I get in. And then when it drops 50%, they don't want to get in because the psychology just, it blows my mind at times. It really, really does.
But you guys don't think Lehman Brothers are coming back? I'm still holding Lehman. One day I think they're coming back. So I don't know. That's a good strategy. Just buy hold forever. How often, if we talk about long term investing, considering you have the Fidelity background and stuff like that, because I think a lot of ignorance is bliss when it comes to investing in general. I think that strategy of everything goes up is a it's a true, absolutely true concept, except for the ones that don't ever come back. How often should people be re-looking at their long-term investments and reanalyzing their strategy of how they buy or if they're selling? How frequent, how hands-on does a long-term have to be for you?
Great question. when I was working with a lot of just a huge array of investors, and Fidelity has its roots in mutual funds. And when it comes to long term investing in a mutual fund, what I would share based upon my training is you're hiring that professional manager, and his or her role is to find you the next Apple, Facebook, Meta, Google. That's their job. And knowing that, that's you don't have to worry about stock selection, but you do need to understand that there's going to be multiple times in your life that the mutual fund's probably going to lose half its value. And it's your job, as hard as it may be, to not sell once it's down 50%, because there will be the next generation of amazing companies that will come up, and most likely they're going to be in that portfolio at some point. And I think so. How often should you analyze that? I think that, I mean, it's almost like writing down on a piece of paper, I promise myself I will not sell when this mutual fund is down 50%. So, but for more of a trader, it's just a lot different. I firmly believe that I think I listened to one of your shows, Dan, where you're like, my percent, I can handle like my two risk units in one day, or it was like 5 risk units in 1 week. So having a written plan of what you're willing to stomach when the market's pretty sour, I think just reverting back every quarter for a trader is incredibly important to look at your rules. And then I personally take the 3 stocks or ETFs that did really well and the 3 stocks or ETFs that did pretty lousy. And I try my best to say, okay, well, what can I possibly learn from this? Did I follow my rules? Did I let the stop get a little bit too loose? Did it gap down? So I share this with clients where a lot of long-term investors really, minus the one stock makes up a enormous part of your portfolio, you're probably somewhat diversified already, just managing kind of negative earnings, negative sales. But for the trader, I think it's going back and having a kind of a playback where you post analyze your best stuff. And I would share that with clients. And I know probably most of them didn't do it, but I think it's incredibly important.
Now, being a financial planner, because I know a few of them, the education that you have is very different than, say, the education that Dan and I have and that we teach. And even the way that you approach stocks, ETFs, all that type of thing, the way you approach the markets, it's very different. And I'm just curious, how long did it take you to kind of do that transition or into the swing trading aspect of it? So switching that brain from being a financial planner to an actual trader, and then are there any similarities that you can take with it that have helped you or inhibited your ability to successfully be a swing trader?
Great question. So for me personally, I was trained by Fidelity. They're primarily an asset allocation model portfolio type of an investment firm. And then they also offer an array of kind of everything from mutual funds to kind of anything. But I would say for those that need more help, it's a diversified pie chart type portfolio. And that goes for the majority of wealth planners in kind of, or maybe globally. So where that was also years later stamped through my certified financial planner education during the investment phase. So you learn a lot about risk, but you'll primarily learn more about just kind of what asset allocation is and why it's so important. In my opinion, for a large majority of investors, that is a good strategy. And primarily the reason it's a good strategy is because most people don't dedicate the time or the effort to outpace that. And they'll make their biggest mental mistakes at the absolute worst time. So that strategy that was kind of brought to me by my company, brought to me by the CFP, was long-term, mathematically, throughout history, it should work. There will be decades where it is the most frustrating, painful experience you've ever experienced in your life, as you've seen your portfolio contract 10 to 20% this year. But if I rewind back, I was young and I was in my late 20s, early 30s, and the year 2007 rolled around, and then 2008 rolled around. And I'll never forget, it was like September timeframe. The market was down 20%. And then later in the fall, which there's a lot of similarities to, maybe not from a contagion standpoint yet, but there's a lot of, if you look at a chart from 2007, you look at a chart to 2021 to 2022, you had these 4 waves down, which happened in 2007 to 2008. And then over the course of the summer, in July and August, it kind of bounced around a little bit higher. And then, holy smokes, starting in the September, October timeframe, it was just horrific, where every single day the volatility spiked, the market pulled back. And for me personally, I was sitting across the table from investors and clients, and it was so painful. So people were saying, kind of, get me out. And you're like, I have to revert back to the financial plan. And the financial plan data was changing so frequently. So it was just so hard that I was like, how, there's got to be a better way. Like I have to figure out something where, whether they take a quarter or half or something of their portfolio and do something different, just to not experience this. I mean, losing 50% of your net worth is just devastating. I mean, 100% just to get back to even. So for me, that was the moment where I was like, I have to figure out, I have to educate myself, which turned into like multiple sets of books of like, where else can I learn this? And will these clients come back? And how many years will it take these clients to come back? And luckily, it was only like 3.5 years after 2008. In 2020, it was just a few months, so no big deal. But I think the big challenge is like, what if we're in a long-term downtrend? No one's experienced that, gosh, in decades. So that's where everything for me was like, maybe I should question a little bit of the traditional thinking.
Right.
So in regards to the traditional thinking, what approaches are you implementing that, or what strategies would you implement that would protect the capital that you have or somebody might be managing, as opposed to the traditional? Because I think that is common knowledge at this point, where they go, just if it doesn't matter how much you're down, don't freak out. That depends on how old you are, how close you are to retirement, what your lifestyle is. There's how overweight somebody is in a position, how much margin somebody might be. There's a lot of factors that I don't think go into the common phrasing of a certain sentiment. Where maybe the next 10 years, but like you said, if this, let's say we're about to, I'm not saying it is, but let's say we are about to go into a long-term 5, 6, 7 year downturn it's possible. Anything is possible. But how does those clients now prepare themselves for that situation when buying and holding doesn't work?
Great. Yeah. So it's like, what do they do? So I run a live spreadsheet that's in the members area, and there's 3 levels. And level 1 is just primarily stocks and hedges, which I'll cover the most on. Level 2 is just other ETFs. So even during a tough market, as long as the volatility is not incredibly high, you've seen things like staples and healthcare held up quite well, and utilities held up. And then tab number 3 is these billion-dollar fund manager stocks. And when you're in a crashing like environment, that supersedes, the trend roadmap supersedes all the billion-dollar fund manager research, because it says be cautious. So if I focus on stock indexes and hedging, so in a retirement account where there's no taxes and there's no real impact, where if you just sold, there's no big deal, I would encourage building levels of cash. And where when the trend roadmap, when the short-term trend starts to peel over, and it starts to turn to a negative trend or a downtrend, and then you also have the long-term trend slowly kind of rolls over as well, it's time to be building cash. The Federal Reserve is not on our side right now. They're getting high inflationary data, and the reality is that their focus was on employment, and now it's on inflation. And inflation, based on a month lag of data, is lingeringly high, so they're not going to come to the rescue yet. So because of that, in a retirement account, you can just, for an investor, building cash, there's nothing wrong with it. And there's nothing wrong with just playing a lot of defense through cash. In a non-retirement account, again, not direct tax advice in any sense, but a lot of clients the last decade has been really fruitful. So you're holding a lot of embedded capital gains. So there's a lot of names that maybe you just don't want to sell because you're not ready to pay a huge, just sell everything across the board. And Times are short. So what I encourage is mathematically figuring out, and I help, whether you use just very simply an inverse ETF. Some clients prefer to use less capital, so maybe they're using some leverage. That's very much a trade. It is not meant to be held for long periods of time. But I've found that from some of my members, that's a big, even though it's so identical to placing any ordinary trade, by using an inverse ETF, it's so you don't have to figure out the options market, and you don't have to get the time perfectly right and deal with a ton of decay if you're using a non-leveraged inverse fund. But you can add a hedge or an inverse ETF to your existing portfolio where you've loosened up some of the cash, and that way at least you're minimizing some of the blow of the down market. And that's some areas of where I give signals on when it is time to add a hedge and really when it is time to take it off, because it's hard because these downtrends are so much faster than the long-term uptrends.
Now, what are some of your favorite moving averages that you would be using for trend analysis?
Well, I focus primarily on exponential moving averages because I want to see the short-term data more pronounced than some of the longer-term exponential moving averages. I don't have any ones that I adore, but in the system, we look at multiple. So we're looking at lots of different moving averages. We're looking at different time frames of those moving averages, daily, weekly. We're also looking at different time frames of the relative strength. So we're looking at this. I'm looking at this religiously. And then I do have a couple other ones that I do look for from extension. I think nothing's perfect, but I do think looking at something like a Bollinger Band is really sound for figuring out when something is wildly extended to the upside or downside, when maybe it is time to go from buying to holding or taking some off the top and taking some profits off the table.
Now, you're without making this financial advice or suggestion to even get into it, but what's your favorite stock right now? Like, what are you looking at that you're really curious about?
Yeah, I'd say so. A couple of names that are my favorite stock. Based upon when kind of the stars align, it's kind of sad. We're in such a defensive environment. That's where it's kind of sad when you're playing with large cap defensives. It'd be so different if this was like a better environment. A name like I'll give a bunch of healthcare names like United Health Group or Vertex Pharmaceuticals. These are more larger cap names with sales and earnings. I'll probably lean you more towards United Health Group because it just reported, and it does not have the world's most exciting earnings and sales numbers. They're double digits, but they're not like explosive growth numbers. But that's the type of names where huge billion-dollar fund managers hide. So those are the types of names. I'd say on the small cap side, last week flashed a buy on. There's a bunch of staples. Constellation Brands was in there. I can't really recommend because I barely have any hair, but like Olaplex, which is a small cap. It's just people keep buying shampoos and conditioners. And I want to see more consistency with some of these names. I'm trying to think of any other ones that were interesting. Harmony Biosciences was probably the most growthy name that I saw, which is HRMY, that showed up for a few months in a row. And then now they start breaking out and it's exciting, but just tighten stops is where we're at.
Right. Now, have you seen a shift going from, say, tech into healthcare? Is that kind of what you're seeing in the analysis that you're looking at?
I saw a shift away from tech a while ago. So that happened a bit ago. I'd say the biggest shift by far was a lot of these funds were late to the energy trade. And for the last, call it like 5, 6, 7 months, it's just been deploying more and more capital to energy stocks. So you've had this kind of very vicious sell-off in commodities. So what I'm waiting for is the turn. So based upon billion-dollar fund managers, I don't think the energy trade is totally off the table at this moment. So Most of them are on sell signals from the trend roadmap, but based upon the consistency of buying, it went from more tech to more commodity. And commodity, I've seen more defensives. So it's been more staples and healthcare is where most of the flows have been going. I wish it was more exciting, but it's definitely a defensive time for a lot of these funds.
It's a great opportunity for learnings. I mean, this is a market that not a lot of people have experienced before, and it's good. I mean, because that's how you learn. You learn, you get better, and having this conversation with you has been very enlightening. And it's definitely got me curious about looking at a few things and taking a peek at how I can implement some of the things that you're talking about into what I do. I did sign up for your newsletter, so I'm waiting to see what happens if I get that. I just did that today, so I'm looking
Thank
forward
you.
to reading it. But anyway, it has been an absolute pleasure talking with you. Do you have any last minute tips or suggestions for our clientele or for our viewers?
No, I think you guys preach it incredibly well. So I would just say just to write down some of your rules and abide by them would be my biggest tip. If you're looking to learn a lot more about trading, I think where I come in is more idea generation. And I really think that some of the products and like the free content, I mentioned this to Jeremy and to both of you, that just the level and the amount of free content that real life trading delivers is so fascinating. I wished for all of those clients that would sit in that hour-long meeting and kind of watch this, like, what is a trend line breakout, and they'd be on the edge of their seats, like they would have gone bananas for your content. I mean, they would have I mean, actually had more actionable items because they don't know where to find a trend line breakout. They have no idea. So I think that your education content is definitely a great stop for kind of, I highly encourage signing up and going through some of that education content. And then I hope I can be helpful, but thank you so much for having me.
No, that's great. And we will put all of your contact information in the description below. So anyone that wants to reach out to Scott will be able to find all of his information down below. So
yeah, I think the information you're providing is phenomenal and will help a lot of traders just kind of own the craft of being able to successfully navigate the market and give them more suggestions as far as ideas of maybe where they should focus attention to, which is outstanding. So, Scott, appreciate you coming on the Pivot Podcast with myself and Tracy. We'd like to have you back one day in the future when we get some new updates and maybe market conditions change and all that stuff as well. So, we'd love to bring it back on. But once again, thank you for listening each and every week to the Real Life Trading Pivot Podcast. We will see you again next week.